Hi, and welcome back to Hedge Fund Manager. I'm Karl-Mikael, and we will now delve into the fundamentals of Centene, this healthcare company in the US involved in Medicare and Medicaid. So, fundamentally, what's going on, what actually produced this perhaps opportunity, is that about a week ago, when this is recorded on July the 1st and 2nd in 2025, Centene abruptly pulled its full-year financial outlook after internal data from 22 out of its 29 Affordable Care Act marketplaces. So Affordable Care Act is like a government program. So 22 out of 29 of these units revealed slower enrollment growth and significantly sicker than expected enrollees. So people are allowed to go into these programs, and they did so slower than expected, so you get less compensation from Medicare and Medicaid, and the ones enrolling were sicker than expected. So that means higher costs, more things to do for Centene, but with lower compensation because there are fewer of them. And the variable compensation, this final part is my guess, is not enough to compensate for how sick they turned out to be. So this quote is leading to much higher patient costs. So now for a change in these deep dives are actually going into the actual operations of the company in our analysis. But we're not going to go too deep, but we need to know at least a little bit about why did the share price suddenly crash, and how long will this negative effect keep going on. So they have lower revenue, higher costs, a much lower EPS guidance. So they guided down from about $7 per share in earnings per share for the full year, and they guided down by as much as $2.75. All because, of course, then that the ACA, the Affordable Care Act, so this government program, and the Medicaid insurer model, they're so sensitive to the enrollment mix. So that is, how sick are the ones that are enrolling into these programs, and the cost assumptions, of course. This should be a bit surprising to us, and apparently it is to the market as well. How can these huge programs, these large populations of people needing care, how can they move so quickly that it produces a crash of 30% for the stock price? That is what's surprising here, and I suspect that this is an overreaction. That is why actually we are looking into Centene. So if it weren't for last week, when this is recorded, today is the 10th of July 2025, then EPS was chugging along fine, and not only fine, it was actually going up by a lot recently. So the last 12 months were at $6.3 per share, and it seemed that if it was going for about a $7 total for the year. However, revenues had been plateauing for the last couple of years, but as you can see, there is no drama here, and even in the last few years where we're talking about a plateau, the growth rates here are in the 4 to 7% range. So this is about nominal GDP style type of growth, which is exactly what you should expect from a company like this. Typically, I would say that a Medicare Medicaid healthcare company like Centene, it more or less is the average of the US economy. And maybe you should also add on that it's a slightly better than the economy, simply because it's a large company and it's exposed to the growing healthcare industry. On the other hand, sure, it has a slight political risk due to it being a tax financed, their revenues are tax financed. But just take a look at the valuation. This is what's creating the opportunity. So we have the two parts of the fundamentals. One is how much revenue and profits are they producing, and how is the market valuing those fundamentals. So taking a look at the valuation multiples, the EV to sales, it used to be in about the 0.5 range, which is actually, that is very low for any company, probably because you consider this a boring enterprise. You know that there will never be explosive growth, never anything super exciting on the upside. On the other hand, it's very reliable and just a stable earner anyway. So at 0.5 you get something very stable at a cheap price, and that should have been a good prospect for a long time, and it also it was. But now the valuation has crashed down to, take a look here at how it's first gradually moved down from 0.4 times sales, slowly grinding down to 0.2, and then crashing down to 0.1 times sales. So this is a company where there is absolutely no confidence left at all in the market as for their capacity for making money and keeping their spots in the market. And I just think that is plain wrong. And profit forecasts, they have adjusted sharply. So you can assess a company from several points. We have sales, we have earnings, and we have assets. Those are the three main fundamentals we're always looking into. So we started with sales, and now we're at earnings. And the price earnings ratio, it used to be at about 15 times. So exactly what you could expect from an average company, growing with the economy, having an average profitability. So this is really the epitome of being average. But then they were down to, for a while, almost 5 times earnings. But now it's exploded up to almost 10 times earnings. Still, of course, extremely cheap if these earnings will continue at this level, and let alone if they were to increase and make a bit of a comeback to previous levels. In that case, we have a very good upside. So the problem here is that we have this sudden jolt, this shock where they have reduced guidance, but they have reduced revenue guidance with just a couple of %, but they took down the EPS guidance significantly. Also, the company is saying that they don't really know what's going to happen in the future. They will have to see what the other 7 out of their total of 29 ACA regions will say. So probably you will see an even a little bit more reduction of EPS for this year. And there is reduced visibility for 2026. So we don't really know where that is going either. But ultimately, I expect this supertanker to recover both its revenue level, its profit margins, and its EV to sales ratios. But it will probably take a couple of years to get back fully. However, it's now is the time to buy it then, because this is the point from which the slow recovery is starting. And if they only recover the price to sales ratio of 0.2 from 0.1, if they do that in 2 years, that's a CAGR of 40%, which is a huge upside for us if we are right.